Hi, I'm Jimmy. In this video, we're going to look quickly at what's happening with unemployment in the United States and how that could impact the broader economy. Then we're going to take a quick look at what's happening with the growth of GDP in the United States, since it's widely expected that the GDP numbers for the second quarter of 2020 are going to be terrible. Okay, so let's jump right into what's happening with the jobs market and what this could mean for the broader economy. So this is a year-to-date chart of what's happening with jobless claims. And as we can see, there's been a huge jump once the coronavirus happened and lockdowns, not just in the United States, but around the world began to happen. And relative to pretty much every time in history, this is the biggest spike we've ever seen. In fact, during this recent spike, 33 million people have lost their jobs, which is clearly a huge problem on so many fronts. Now, from purely an economic standpoint, this raises the question of how much will this impact the broader economy? And to see if we can get an idea, let's switch this jobless claims chart over to real GDP. So this is a chart of annual changes in real GDP in the United States from about 1970 to a couple of years ago. Now, clearly, there are a few big dips in GDP. These are the ones we're most concerned about, with the most recent one being during the financial crisis. But now if we clean this up a bit and then we add jobless claims, well, now we may notice that jobless claims spike, and shortly after that, GDP, there's a big drop off. And I'm sure this is logical since jobless claims tend to do a decent job of predicting a pullback in GDP. Now, I also want to point out the difference between jobless claims and unemployment. Jobless claims come out every week. Unemployment comes out every month. So there are different numbers. Unemployment actually tends to be a lagging indicator. Jobless claims tends to be a little bit leading. Now, part of this is simply timing, since after all, jobless claims come out more often, and GDP only comes out once a quarter. So we're going to get a good idea of what's happening with jobs throughout the quarter, and then GDP comes out after that. So in theory, once a recession hits, well, we would see jobless claims jump first, and then after that, we would see a pullback in the growth of the economy. But what I think is somewhat interesting about this is that we may notice that when jobless claims jumps the most, well, that's quickly followed by the worst dips in GDP. So in theory, we can use jobless claims to gauge how far down GDP might go based on how high jobless claims jump. Now, we may also notice that I only went up to 2018 here, and I did that because when we switch over to jobless claims for 2020, well, we can see that compared to every other spike before this, the current spike is absolutely crazy. Okay, now this brings us over to the potential impact on GDP and ultimately our investments. So now let's switch over to the quarterly changes in real GDP. Real, once again, is after inflation. The most recent numbers that came out for 2020 came in the first quarter, came in at negative 4.8%. And broadly speaking, economists are expecting for the second quarter to be way worse, since the global lockdown is really extended through the entire second quarter. Even as things open up, it's going to be far more gradual. So I've seen estimates as low as negative 27% or to negative 35%. And if we think about the comparison that we just saw between jobless claims when the spike goes up, GDP goes down, well, this is a much higher spike up. So the fact that we would end up with one of the worst drops would make a lot of sense. And this simply has to bring us to the question, why would we possibly invest now, knowing that things potentially could get this bad? Even if the number came in on the low end, called the negative 27% range, well, that's an enormous drop. How long is it going to take for the economy to recover from that? And relative to that kind of drop off on the horizon, I've seen a few comments saying that the stock market isn't down nearly enough to justify investing at this point with a potential drop like this right on the horizon. And one comment even went a bit further and explained to me that when I do discounted cash flow valuation methods, I often use a economic growth rate of 2.5% when I'm trying to calculate the fair value for an individual stock. And that's true. I do use 2.5% almost every time. But the comment went on to explain that in the second quarter alone, expectations are that GDP will see a huge drop. Let's say negative 25%. Sure, it could be lower than that, but let's just imagine it came in at negative 25%. Well, at just 2.5% growth, assuming growth starts next year, our assumptions would be that it wouldn't get back to the old highs for 10 years 2.5% for 10 years, you make up the 25% lost. Obviously, this would never work out that way and never be that smooth. But when I read that comment, I realized that there was a big misconception about what is actually happening here with GDP. So to illustrate, this is a chart of the actual dollar value of GDP going back to World War II. And clearly, we can see the United States has done an impressive job of consistently marching higher. In fact, when we look at the longer term chart, well, right now, the financial crisis right there, it doesn't even look that bad, even though anybody knows who was in the brunt of it when that was going on, knows it was terrible. It was, in fact, the worst one since the Great Depression. And if we zoom in a bit, well, now we can see the current drop-off has already begun to appear for the first quarter of 2020. But for now, I just want to focus on the financial crisis to explain how these types of economic numbers actually work. So let's zoom into just the financial crisis. So the economy was doing well, GDP was moving higher, mostly higher, and then things started dropping. And the drop was a fairly big drop. But on a percentage basis, how much of a drop did GDP actually see? Well, after accounting for inflation, since these numbers are real GDP numbers, well, the drop-off was a bit less than 4% from the peak to the bottom. Now, this was actually a huge drop in an economy as large as the United States. Drops like this are terrifying since when you're in the middle of it, no one knows where it's going to stop and how bad it's going to get. But with hindsight, we can see that by 2010, GDP had almost gotten back to its old high. It didn't quite make it there in 2010. It was actually 2011 when GDP passed their old highs. But either way, that's a fairly quick turnaround coming off of one of the worst economic downturns since the Great Depression. Sure, we could say what we want about how it got there, stimulus, the government, the Federal Reserve. Fine, all of that is true, but either way, the economy still turned around. But now when we switch back to the quarterly changes in real GDP, well now, when we look at the financial crisis, we can see that clearly this dip here looks like it was way worse than a 4% drop in GDP. How did this happen? This data came straight from the Bureau of Economic Analysis. So this is the official source. These are the official numbers according to the Bureau of Economic Analysis. Well, the key point for us to realize here is that all quarterly GDP numbers are annualized. What does this mean? Here's a quick example to illustrate. Well, what if I told you that I found a CD you could buy from a bank for 3 months. It's a 3-month CD, and we're going to earn a 10% interest rate. So we decide we're going to go invest $1,000 in it, and it's going to pay us a 10% interest rate. At the end of the CD, we get back our money, and which when they give it back, they give us the original money back plus the interest that we earned. But how much are we getting back? Well, at first glance, we might say, well, we invested $1,000, we made 10%. That means we earned $100 on the 1,000, so we should get back $1,100. But we'd be wrong if that's how we did it, because this was a 3-month CD, which means that we only earned 1/4 of that 10% since we only invested for a quarter of the year. So when we get back our $1,000, it'll be $1,000 plus $25 in interest. And this is the key misconception for the comment that I mentioned before. See, virtually all interest rates that we're going to see pretty much anywhere are going to be annualized interest rates. So in our 10% CD example, when we go to the bank and if there's a sign there and they're paying 10% because maybe it's like 1980 or something, I don't know. But there's going to be a sign. They're not going to say it's an annual rate. They're just going to say 10% CD 3 months. We have to know that, okay, we're going to get a quarter of that. If you invested for a year, fine, you'd get the full 10%. But they have no obligation to disclose that 10% is an annual number. We just need to know that. But if we didn't know that, well, we might have been a bit disappointed by the fact that we only received a $25 interest payment. Okay, now swinging back to GDP. Now, when we look at just this 1 quarter here, let's call it -8%. It was actually 8.4%, but we'll keep the math simple. So we know that this is a quarterly number, which means a -8% number was actually a -2% loss for the quarter. Then they say, okay, we lost 2% for the quarter. What if that happened for the whole year? You extend it, multiply it by 4, you end up with an annualized rate of 8%. Now, if we were to update this to today, and then let's add a hypothetical second quarter, and let's pretend that the second quarter of 2020 comes in at -30% for GDP. Yes, this is a tragic situation, and this could very well lead things to be worse than the Great Depression from both a job loss perspective and from an economic pullback perspective. But thinking strictly from an economic standpoint at this point, I just wanted to point out that if GDP does come in at negative 30%, well, that doesn't mean that the US economy lost a third of its economic value. It lost about 7.5% of its economic value. Devastating, yes, but not 30% devastating. So if we're planning out a potential road to recovery, and going back to that comment that I saw, well, if we wanted to use 2.5%, it would take a little over 3 years to recover from that 1/4 loss, assuming it was actually negative 30%, which would be a real term of negative 7.5%. Now, either way, that's a terrible situation from an economic standpoint, but the difference in our own planning for our own investments from, all right, we could potentially recover from this in 3 years or 4 years or 5 years, because they got to make up the other down quarters as well. But a few years versus 10 or 12 or 15 years, those are very different scenarios. So I just wanted to point out how GDP actually worked. To me, the real question, the real focus is jobs. How quickly do jobs come back once the economies open up again? Do they come back slowly, or do we see a nice pop with people finding jobs once again as things open up? Hopefully it's the latter. Forget about the economy. People lost their jobs through this, through no fault of their own. So to me, I'm hoping that the recovery is very quick, and I'm hoping that people are able to get reemployed very, very quickly. Now, we may have seen that the unemployment rate is up near 14.7% right now, which is terrible. This is the worst level since the Great Depression, and it's probably going to get even worse than that. But unemployment is another one of those tricky numbers, a lot like GDP, that can be misleading, and in this case, misleading for the worse. And if you're curious, I actually did a video called The Truth About the Unemployment Rate, and I go through how it works and how we can see some other interesting details besides the headline number. So if you're curious, there's a link right here. There's a link in the description below. And thank you so much for sticking with me all the way into the video. I really appreciate it. Thanks, and I'll see you in the next video.